The notion that the next market crash could present a significant opportunity is based on the idea that financial downturns can create favorable conditions for certain types of investments. While it's important to note that predicting market crashes with accuracy is extremely difficult, historical patterns have shown that market downturns have often been followed by periods of recovery and growth. Here are a few reasons why some investors see potential opportunities during market crashes and how you can profit from these. Reason number 1: buying assets at discounted prices. During a market crash, asset prices tend to decline significantly. This can create an opportunity for investors to purchase stocks, bonds, real estate, or other assets at lower prices than their intrinsic value. If the market eventually recovers, these investments have the potential to generate substantial returns. Lower prices than intrinsic value. During a market crash, panic selling and negative sentiment can cause asset prices to drop. This can lead to a situation where the market price of an asset is lower than its fundamental or intrinsic value. Intrinsic value refers to the true worth of an asset based on its underlying fundamentals, such as earning potential, cash flow, or underlying asset value. Investors who can identify assets that are undervalued relative to their intrinsic value may see an opportunity to purchase them at a discount. Long-term investment horizon. Buying assets at discounted prices during a market crash is typically seen as a strategy for long-term investors. It requires a patient approach, as it may take time for the market to recover and for the asset prices to appreciate. Investors who adopt a long-term perspective understand that short-term market fluctuations are a natural part of the investment cycle and believe in the potential of the assets they purchase to deliver value over the long run. Diversification and risk management. It's important to note that investing in assets during a market crash carries risk. Market downturns can be prolonged, and it's possible that some assets may not fully recover or may take an extended period to do so. It's crucial for investors to diversify their portfolio and carefully assess the risk-reward profile of each investment. Diversification across different asset classes, sectors, and geographical locations can help mitigate risks and increase the likelihood of overall portfolio success. Fundamental analysis and due diligence. To identify assets that are undervalued during a market crash, investors often conduct thorough fundamental analysis and due diligence. This involves evaluating the financial health, competitive position, growth prospects, and industry dynamics of the companies or assets under consideration. By understanding the underlying factors that contribute to an asset's value, investors can make informed decisions about purchasing assets at discounted prices. Reason number 2: potential for substantial returns. If the market eventually recovers from the crash, the assets purchased at discounted prices have the potential to generate substantial returns. As market sentiment improves, the demand for these undervalued assets may increase, driving their prices back up toward or even above their intrinsic value. This appreciation can result in significant capital gains for investors who bought during the market crash. Fundamental soundness. Long-term investors prioritize the fundamental soundness of companies or assets they invest in. They look for companies with strong financials, competitive advantages, robust business models, and solid growth prospects. During a market crash, indiscriminate selling can cause even fundamentally strong companies to experience temporary declines in their stock prices. Long-term investors view this as an opportunity to acquire shares of these quality companies at lower prices. Lower entry prices. Market crashes often lead to significant price declines across various asset classes. For long-term investors, this presents an opportunity to buy assets at lower entry prices. By purchasing assets during a market crash, investors can potentially lower their average cost basis and enhance their long-term returns. Lower entry prices can amplify the upside potential when the market eventually recovers. Navigating short-term volatility. Market crashes are characterized by heightened short-term volatility and uncertainty. However, long-term investors understand that short-term market movements are often driven by emotions, panic selling, and temporary disruptions. They believe that by maintaining a long-term perspective, they can ride out the fluctuations and benefit from the eventual recovery and growth of the market. time in the market, not timing the market. Long-term investors prioritize time in the market rather than trying to time market cycles perfectly. Instead of attempting to predict the exact bottom of a market crash, they focus on staying invested over the long run. By remaining invested in quality assets, they aim to capture the overall upward trajectory of the market and benefit from the compounding effects of returns over time. Embracing historical patterns. Historical data indicates that markets have typically recovered from downturns and gone on to reach new highs. Long-term investors take solace in these historical patterns, which suggest that market crashes are often followed by periods of recovery and growth. By staying committed to their long-term investment strategies, they aim to capitalize on these eventual recoveries. Reason number 3. Dollar cost averaging. Market crashes can be an opportunity for investors who employ a strategy known as dollar cost averaging. This approach involves investing a fixed amount of money at regular intervals, regardless of market conditions. During a crash, this strategy allows investors to purchase more shares or assets at lower prices, potentially increasing their overall returns when the market rebounds. Consistent investment approach. Dollar cost averaging enforces a disciplined and consistent investment approach. By investing a fixed amount at regular intervals, such as monthly or quarterly, investors remove the emotional temptation to time the market. This systematic approach helps avoid making impulsive investment decisions based on short-term market fluctuations or attempting to predict the market's highs and lows. Lower average cost per share. During a market crash, asset prices typically decline. When using dollar cost averaging, investors benefit from purchasing more shares or assets when prices are lower. This leads to a lower average cost per share over time. As a result, when the market eventually rebounds, the overall return potential increases since the investor owns more shares or assets that have appreciated in value. Mitigation of market volatility. Market crashes often come with increased volatility, which can make it difficult to time the market effectively. With dollar cost averaging, investors effectively mitigate the impact of short-term market volatility. By investing at regular intervals, they automatically buy more shares or assets when prices are low and fewer shares or assets when prices are high. This smoothing effect helps to average out the cost of investing over time and reduces the potential negative impact of making significant investments at unfavorable market peaks. Reducing the risk of making poor timing decisions. Attempting to time the market by making large lump sum investments during a market crash is a risky proposition. It's notoriously difficult to predict the exact bottom or recovery of a market. By utilizing dollar cost averaging, investors reduce the risk of making poor timing decisions. Since investments are spread out over time, they avoid the stress and potential regret of making a significant investment at the wrong time. Building a disciplined investing habit. Dollar cost averaging encourages the development of a disciplined investing habit. By regularly investing a fixed amount, investors cultivate a consistent saving and investment behavior. This systematic approach can help individuals stay committed to their long-term financial goals and avoid making emotional investment decisions based on short-term market fluctuations. Price appreciation potential. Value investors anticipate that as market sentiment improves, the undervalued assets that they have invested in will experience price appreciation. When the broader market recognizes the underlying value of these companies, their stock prices may rise, potentially resulting in significant returns for value investors who purchase the assets at a discount during the market downturn. Thanks for watching this video. See you soon.